Housing feels strange right now. Delinquencies are rising. Foreclosures are moving higher. Signs of borrower distress are clearly visible, but home prices haven't collapsed. So, what's really happening inside the mortgage system? And how serious are these risks? To help break this all down, I'm joined again by John Comiskey, a widely followed Substack writer who studies housing and mortgage data in extraordinary depth. John, let me start with something that scares a lot of homeowners. If you miss mortgage payments today, do you lose your home?
No, you do not. Eventually, if you keep missing mortgage payments and you can't bring the loan current, then eventually, yes, you will, but that's a fairly long and drawn out process, which previously was made even longer with some of the COVID era, or pardon me, the 2020 era uh, programs that got put into place. But to answer your question directly, no, you will not immediately lose your house. You will have a lot of time to catch up, and the servicer of the loan, the people that you pay your mortgage payment to, they will work with you to try to get to a financial resolution with you, which may include lowering your payments, et cetera. There's a variety of things that they have in the playbook in order to try to keep you in that house. It's in everybody's interest if you can get to a payment that you can afford and stay current on the home.
I think that's something maybe a lot of people misunderstand. That if you miss a mortgage payment doesn't mean you're going to lose the home, obviously immediately. Having said that, it seems like, we have millions of borrowers right now that are struggling with payments, in recent years. Yet foreclosures did not surge. Why has that not happened?
Well, so this goes to the programs that I was referencing that were put in place in late 2020, 2021 timeframe, to as part of the government response to the pandemic. And what those programs did is they took loss mitigation. And what loss mitigation is, that's the term for the process where the servicer works with borrowers who are delinquent on their loans. They've missed some mortgage payments. So the servicers will work with the borrowers in a process called loss mitigation. And what happened as part of the government response to it, particularly with FHA, although also with the Fannie Mae and the Freddie Mac for kind of more the better credit risk borrowers who were in those portfolios. For both of them, they created very, very generous loss mitigation programs. So generous, in fact, for the FHA that it was basically prior to October 1st of this year. It was basically kind of impossible to get foreclosed upon unless you either abandoned the property, like just totally walked away from it, or B, you completely ghosted your servicer. You just didn't talk to them. Under those circumstances, they could move towards foreclosure. But if you talked to them and you were willing to take a workout option that they would give you as part of this loss mitigation discussion, even if you had no intention of actually honoring the terms of that workout agreement that you reached with them, then you would be offered one. You could take it, and that would bring your loan current. And then you would just go through the cycle again. If you kept missing payments, you go through the cycle again with them, 3, 6, 9 months later.
Yeah, so that feels probably to many, it feels completely counterintuitive, right? Like, wow, most people have been taught that if you miss mortgage payments, you're going to get foreclosed on. And so this, something obviously was propping up the foreclosure market, or I guess suppressing the foreclosures coming through the system, and kinking the hose, for an analogy, right? For the viewers, like, hey, I kinked the hose, I'm keeping the foreclosures from coming through, but that doesn't stop the fact that there is pressure building behind that that kink. And I think this is where a lot of viewers, a lot of people just get surprised, right? They're like, "Wow, I didn't know something like this was going on." But it sounds like now that is, I mean, a big part of a big part of your Substack is uncovering the fact that that is ended, or that has ended, right? That loss mitigation, they've changed or put guardrails around it. And so, what has materially changed behind the scenes now?
Okay, so there's two things that changed about the actual loss mitigation programs. The first one, is that the FHA changed the rules that limited workouts that are home retention. And what that means is that's a workout where the borrower stays in the home, as opposed to a workout with the borrower that avoids foreclosure, but does involve them leaving the home, like a forced sale or a short sale, or potentially a deed in lieu of foreclosure. Those are foreclosure alternatives, but the borrower loses the house. But the home retention options, the borrower stays in the home. And what the FHA did is it limited the borrower's ability to get a home retention option to one every 2 years. So if you get a home retention workout, then you can't get another one for 2 more years. And what are the big home retention options for FHA? There's two primary ones. One is what's known as a partial claim. And what that means in layman's terms is the FHA basically covers the payments that have been missed. And by covers, it doesn't pay them for the long haul. It pays them immediately to bring the loan current, and so that the servicer gets reimbursed the money that they have not been paid by the borrower up to that point. And then the FHA takes whatever that amount is and they add it to the loan as a non-interest bearing junior lien, which has to be paid back when the home is sold, or if the mortgage goes the distance and eventually matures, then it would be paid back then. So the FHA is not literally just covering for the borrower, but they are temporarily, and they're doing it at 0% interest on that junior lien, which is a pretty good deal. But so that's one of your main home retention option possibilities. And from a borrower's perspective, they get a fresh start, but they're making the payment that they've been historically making, prior to them stopping making the payments. The second option is what's known as a loan modification. And in a loan modification, the terms of the loan are actually altered with the intent to lower the payment for the borrower. So this would be for a case of a borrower who maybe now has a financial hardship that's going to be ongoing. Maybe they lost a job, and the replacement job, it pays less, and they just don't have the same income. A loan modification, they'll target lowering the principal and interest portion of the mortgage payment by 25% if they can get there, to provide payment relief for the borrower. Uh, Loan mods are complicated by the fact that when you do a loan modification, you have to also change the interest rate on the loan, set it to market, which when interest rates are dropping can be to the borrower's favor and make loss mitigation easier to get to that 25% payment reduction target. But over, say, excepting the last like 6 months, the 2-3 years before that, that was incredibly complicating because, most mortgages, if you were doing a loan mod on them, would take a 3.5-4% rate and bump it up to 6.5% or whatever. And that makes it incredibly difficult to get 25% payment relief, because that new interest rate just makes the payment so much higher. That said, you got partial claims, you have loan modifications, but borrowers can only get one every 24 months. And if they get a partial claim and then they start missing payments, then their only path, outside of, finding the money from family or friends, or getting lucky with a lotto ticket, right? Their only other path is to go through disposition options and loss mit, where they have to leave the home, or worst case foreclosure.
Okay. Okay. So because of COVID, I guess, and because of the policies that were put in to help protect, in quotation marks, right, protect homeowners, they put in policies that allowed folks to stay in their home while they continued to go back to the well and not make payments. Although those payments, and I'm just paraphrasing, kind of trying to, understand what how the process worked here. Um, they would then just keep extending and pretending, but the debt didn't go away. It was just added on the back of their loan at 0%. So theoretically, somebody could continue to do this again and again and again. Where the old way of doing things with partial claims, and the government was making the payments to the servicer, allowing them to stay in the home and staving off foreclosures, right? But now they've changed that rule as of October, and we're now in a phase where people have a limit. They have a limit on how many times they can do it. Makes a lot more sense, right?
Yep.
Something that maybe folks are wondering, I know I'm wondering, like, if the modification's supposed to reduce your payment, but mortgage rates are higher than when you bought a house, like let's say somebody bought in 2021 or 2020, or I guess probably even 2019, and they now have a higher interest rate, how do they get the payment to, like, how do they meet that 25% reduction in payment? How do they do that? And what happens if they can't?
So they have two more levers that they can pull. One of which is that they can extend the term, and they frequently would. So you would see in those instances where the interest rate was being forced higher, they would kick out the term from 30 to 40 years, which is going to give you, well, or actually maybe 28, whatever they had remaining on the mortgage. They'll kick it out to 40 years, which will give you some measure of payment reduction. But then the other thing that they would do is they would combine a loan modification with a partial claim. So not only as part of that modification would they bring the loan current, but then they would put in another chunk of money to reduce the principal of the loan, right? So if you had 300,000 remaining on your loan, and you had maybe they'll bring it current, and we'll say that cost, I don't know, $20,000, right, in missed payments, and then maybe they'll kick in another $50,000 to lower the principal balance on the loan to 250,000. Combine that with moving the term out to 40 years, and usually with that they could get to some level of payment reduction for the borrower. It wasn't always 25%. Just depended on how much the interest rate was rising, and it depended on how much the borrower had remaining in their, what I call, partial claim budget, because the FHA limited the amount of partial claim that you could get to 30% of the unpaid principal of unpaid principal balance of the loan when you first got one. So if you had originally $360,000 loan, then you were capped at what, 90,000 of partial claims that could be either paid from the standalone or in conjunction with a modification. But they would use, on many of the mods, they would use all of it. They would use every cent that was available up to that 30% cap, to lower the principal to try to get to that 25% reduction. And if they couldn't, then they would offer it anyways to the borrower. If it raised the payment, they would also offer it to the borrower. They had to. The servicers, they have to follow what the FHA's kind of waterfall playbook is, and that's what led to some modifications, particularly after the borrower had already gotten a previous modification that killed any partial claim budget they might have left. The next modification, maybe they haven't made any payments since, on the earlier modification. 6 months later, they're modifying it again, raising the payments, adding more money to the loan balance because you've got the arrearages, like the missed payments, and the servicers were forced to offer that. And that's what I mean. That's kind of brings home you couldn't get foreclosed on if you just played along. All you had to do was play along. But that stops now, right? Because you can only get one every 2 years. And also importantly, you have to make 3 trial payments to get either a partial claim or to get a loan modification. So the nonsense of borrowers literally never making a payment. And to be sure, this was not every borrower in the data by any stretch, but there was definitely more than just a few who were just not making payments within the FHA data. All of them they're forced to, right, with this one last shot at loss mitigation that started in October, because they reset it. They didn't count any of the COVID stuff as year one within 24. That you started fresh in October, and that's what we're seeing right now. Over the last 3 months, we're seeing where the servicers, the whole industry is doing loss mit, but it's, when I say last chance, I mean you get another chance in 2 years, but it's last chance for now, loss mit for borrowers that are in distress. And we're going to find out next month. We're going to start to see in the data how many of those trial payment plans are succeeding versus how many of them are failing, where the borrower can't do those payments to make 3 trial payments to actually even get the modification or to get the partial claim.
Yeah. Wow. Okay. Thanks. Yeah, that makes sense. There's a lot there, and you keep mentioning modification. As you talk about this, I think about your Substack. By the way, again, uh, and I'll put it in the description. But John Substack on this stuff. If you want to know what's happening with mortgages, like behind the scenes stuff, and it's the stuff that most homeowners, most people, average citizen has never sees these. This behind the scenes madness, I guess, that goes on. John Substack is fantastic because part of what you talk about in there, and it sticks in my brain every time I read it, is modifications of doom. Right? I think it's a great slogan. You should copyright it. Modifications of doom, because it sounds like, correct me if I'm wrong, but there are a lot of these modifications where it's probably like the borrower comes out with a higher payment than they did going into the modification. Is that true?
Yeah, there were definitely a fairly large number of these things that happened in the 23, 24, well, no, less 23, but more 24 and into 2025 timeframes. And these are the modifications that raised the interest rate from what the original loan was by a significant amount. And to combat that, right, they had to exhaust the partial claim budget. Uh, maybe you got 15% payment, but that better be enough, because if it's not, then you've got no more loss mitigation ammo to fire at it outside of a collapse in interest rates, which might help those borrowers. But unless and I mean, interest rates have come down a little bit, so there is, from some of those modifications of doom, they could probably get a little bit of a payment relief now if they did one, even with no partial claim budget left. But for the most part, all of the modifications of doom that were performed, and there's, I don't know, probably 125, 150,000 of those modifications of doom. They're pretty much all foreclosures waiting to happen, or well, maybe they're foreclosures, maybe they'll be short sales or deed and lose, but they're home dispositions waiting to happen. And that will feed the distressed supply channel into the real estate market over the next, I don't know, should start relatively soon. Probably another 3 months, we'll start to see the impact of that really starting to hit in short sales. And then it'll carry on for the next year, 18 months after that. And that's just the modifications of doom. There's other segments of the FHA portfolio that will also likewise likely end up in homes coming to the market in the distress channel.
Okay. Yeah, I want to dive into that a little bit. Before we do, though, again, just wrapping up this modification part, like it seems like and I'm just guessing, there's a lot of homeowners that probably use this loss mitigation modification option toolbox to actually help them because they were in distress. They weren't trying to game the system, and they not only came out worse, maybe, but now they also have more debt, right? Because it's not like they just modified the payment. They took a lot of the money and the partial claim benefit and put it on the backside of the loan. So they've got a higher payment, higher interest rate, at least, if not a higher payment, maybe a little savings on the payment, but now more debt. So it probably didn't do them any good in a lot of cases. And there's probably some homeowners that have zero idea that that's what they did. I'm just
Yeah.
assuming.
Yeah, like I have no sympathy for the people who are gaming the system, and not making any payments, right? Like it is what it is, and it'll be good when those homes come back into the system. But you're absolutely right. There are a number of cases where you had borrowers that you look at their payment history, and they had a perfect payment history for like 3-4 years, and then they miss 3-4 payments, um, and then they get one of these modifications. But unfortunately, it took their 3% rate to 6.5%, and maybe they got a 10% payment reduction. But if the borrower answered honestly to the servicer, hey, no, I can't resume my prior mortgage payment, right? At least not right now, because for whatever their financial hardship was, if they had just lied to their servicer and said, yep, I can do that, give me a partial claim, then they would have kept their 3.5% rates. And they could have kept getting partial claims until they were able to pay it again. But instead, they got that modification of doom, and that is pretty much going to end their ability to do effective loss mitigation in the system. In those cases, were an absolute policy failure on the part of the FHA. To the FHA's credit, they did recognize that this issue existed, and they spun up essentially a variant of the partial claim that you can do payment relief with. So instead of forcing a modification, they treat it like a partial claim, but then for a period of 2 or 3 years, I forget which, you can get up to a 25% payment reduction paid for out of the partial claim money. And that was a great solution, but it took like a year and a half to go from concept to actual practice. And there were a lot of borrowers who, unfortunately, that was not available to them during that year and a half. And unlike the VA, right, where the VA just knew, and when they knew VASP was coming, they told the servicing community, we can't hard tell you have to do a foreclosure moratorium, but kind of the wink, wink, nudge, nudge. If you don't, then you're going to be paying for it with us. And the industry did. They basically stopped VA foreclosures pending the VASP program coming online. The VASP program was a VA program where they would buy delinquent loans from servicers and bring it onto the VA's own book. It became controversial, and Congress essentially ended it this past May. But the FHA didn't do anything like that, and as a result, then you are absolutely right. There are borrowers who got who made they put themselves into a terrible position now that the loss mitigation procedures have changed, and it was unnecessary, unfortunately, in retrospect.
One of the things a lot of people have asked me on my channel is like, when were these loans originated? Like the loans that you're seeing the most pain in, or not the most pain necessarily, although that would be interesting to know, but the modifications or the people that are most delinquent with FHA now, I guess it is where the most pain is. When were those loans originated? In other words, are these borrowers that recently purchased homes, or are they borrowers that, bought homes in like 2015 and then this program came out and they're like, I can't make a payment? Or is it more like recent home buyers?
So it runs the gamut, but it is mostly not recent home purchasers.
Hmm.
And you have to be careful with originations, because the Wall Street Journal, there was an opinion piece in the Wall Street Journal that came out like a week before I did my much more detailed kind of expose on what was going on in the FHA program. They that author got a key concept wrong, right? Like a modification is technically a recent origination because it's a new loan. But that's not really uh, but if you confuse that with like new purchases or new refis, cash out refis, or I mean, not that there were many rates refis happening during that time, but it's a completely different kettle of fish. For people who are buying homes or refining homes over the last couple years, they actually perform better a little bit than the portfolio, right? Where you've got loans that stretch back into as far back as the early aughts, on the FHA book. Not a lot of them, but there's still a few of them out there. Um, so you see the delinquency across many of the vintages. I mean, there are some of this delinquency stuff is still loans that have been on and off in delinquency since the GFC. So that's sort of spread out, but what it's notably not is in recent purchasers. I mean, there is some, but it's better than the portfolio broadly as a whole.
Is that because they haven't, uh, it's just a matter of time? Or is there something that's different there? I'm trying to figure out. That surprises me. It would probably surprise a lot of people. Like, I would think, you bought your home 2015, 16, whatever, even early aughts, like you said, you got a better interest rate than you can get now. Home prices were lower, so you figure your payment is lower. Uh, wh- how, what's the reasoning for that? Do you have any idea?
I mean, I would guess it probably has something to do with a more recent credit evaluation, right? I mean, I think like financial hardships can happen to people kind of at any time. But I mean, because you get underwritten when you buy one of these homes. So when you buy a home or you originate a refi, you're not in financial distress at that point in time. Because if you were, you wouldn't be able to get the mortgage to buy the home. Um, so so my guess is that it has something to do with that. Like the origination credit portfolio for FHA is, I mean, it's lower now versus what it was previously. Like the debt to income scores are higher, generally speaking. The credit scores, well, I mean, credit scores are difficult because they've been inflated. They don't mean as much as they sort of used to. But the risk profile is generally a little higher now versus then. But I think you probably just don't run into distress like immediately after you buy a home, and you sort of know what you're getting into as well. So you, for the most part, probably aren't facing some of the shock pressure from like what you're getting into. I guess that's my best explanation for it.
Okay. Yeah, yeah, that's as good as any, I think. As I've it's probably a mix of things, but yeah, good point. If you just bought a home, your credit profile is probably good because you wouldn't have qualified otherwise, and you think everything's okay and you're used to making the payment, but maybe if it's been a long time, eventually struggle. And to your point, if some of these people are from the great financial crisis, then it's been like 20 years, I guess, right?
Oh, yeah,
Or no, approaching 20 years that they've been in and out of this.
yeah.
Wow. Okay, so FHA, a lot of this is all centered around FHA. I keep hearing you mention that. And so FHA loans, they're constantly mentioned when we talk about this mortgage stress. I continue to see more and more headlines and videos and articles about FHA loan distress. Why do FHA loans show higher levels of distress? Number one. And then the second part of the question is, how large is the FHA's share of the overall mortgage market? How big is that piece of the pie?
Okay, to answer the first question, it's broadly because FHA loans are made to the riskiest of borrowers. The answer to the second question, uh, and now my mind is blanking. What was the second question again? Sorry.
Sorry, no. How big is that
Oh yeah, yeah, yeah.
the piece of the pie? The FHA share of the overall mortgage market.
Yeah, the American mortgage market is a little north of 50 million mortgages, maybe 52, 53 first lien mortgages, right? There's maybe another 30 or so of various other like seconds and whatnot. Um, but when you think about the first lien mortgages, 52, 53 of them, 53 million of them, the FHA share of that is about 8 million, little north of 8 million are FHA insurance and force loans.
Okay. It's so I mean, approximately the figures I have are about 11 to 13% of the overall mortgage market.
Yeah, I think it's a little higher than that
Is
actually,
it?
but yeah, I think it's probably closer to 15
Oh,
when
15%.
it comes to those first lien mortgages. But 8 out of roughly 53 ish is a good way of thinking it.
Okay. And then what percentage of the FHA loans right now are delinquent?
Okay, so the FHA publishes that information, but it's with a couple months lag. So they publish it across the entire portfolio, and it's like delinquent. It's like 14%, maybe 15%. So the numbers that I report on in my Substack are on a subset of that. So mine are over the roughly 7.1 million of the 8.1 million that are in what are known as mortgage-backed securities. So these are loans that are held in mortgage-backed securities as opposed to held by the servicer themselves. Um, it which it's the majority of them. It's where it's where the better loans go, because servicers they're not in the business of holding the loans on their own book, but sometimes they have to for various reasons. Um, but so I report on that 7.1 million, and for the loans that are in mortgage backed securities, let me look at the number from last month. Uh, we've got a delinquency rate there of 12.4 and a serious delinquency rate of about 5.15 in the January data. And for reference, like last January, over that same 7.1, we had a delinquency rate of 10.77 and a serious delinquency of 3.4. So serious delinquency now versus then is 5.15 versus 3.5. And if um, you add a little bit to these numbers to get to the full portfolio, which is going to be like 14, 15% delinquency and probably around 6% delinquency or serious delinquency over the entire span of the FHA portfolio.
So, wow, that's a lot, right?
It
I
is.
mean, when you think about that, it means that, shoot, I mean, it's over 1 out of 10, right? FHA loans out there, FHA homeowners, I guess you could call it, are delinquent. And it seems like the serious delinquency is growing to a point that it is going to be 1 out of 10 that are serious delinquent, which means unless I'm wrong here, is 90 days, right?
Yeah,
Or
90 days.
more behind, right?
Yep.
And a lot of times I think that's when foreclosure is like really starting to be real. Um, correct? Is that right?
You're going to generally do your first legal at 180 days. Uh,
Okay.
so it'll be 6 months, but you're getting breach letters from the servicer at 90 days. So the servicer is making it real to the borrower, in part in an effort to get them to engage, to kind of scare them, rightfully so, because there are consequences, but scare them into having the uncomfortable conversation because most borrowers in that situation, they don't really want to talk about it. But they need to, right? They need to have this conversation with the servicers so that an appropriate plan can get picked up. And so, yeah, servicers will start sending the legal letters to them. You're in breach of contract. This is going to go to foreclosure um, around 90 days.
So the obviously FHA has a lot of stress with delinquency, but going back to the piece of the pie, it represents 15% of the total mortgage space, approximately, of the residential mortgage space. So, what about that other piece of the pie, the majority, the 80, I guess it's 85% of the mortgage space? How is that performing?
Uh, Pretty well, actually. For the loans that are in Fannie Mae and Freddie Mac mortgage-backed securities, the the delinquency rates are rising in those portfolios some recently, but they're still at really low levels. They're not at levels that are really concerning at all right now. Maybe they'll get there, but they are not right now.
Okay. Okay. Yeah, that seems like I think the last stat I read was like under 4, but it is rising. It looks like, as I think they were like under 2 at one point. Over the last few years, if I remember right now, I think they're under 4, but they are rising to your point.
Yeah. And then VA sits somewhere in the middle. Their their portfolio performs worse than Fannie Mae and Freddie Mac's, but significantly better than FHA. And of course, because VA had the VASP program while it was up, that relieved a lot of the stress. That took a lot of the stress um, out of well, out of the servicing community. The VA owns those loans now, but they also put them at a 2.5% interest rate. So they gave those veterans as good a shot as you can have at uh, at performing on the loans. And I suspect many of the veterans who got the VASP loans will.
Yeah. Yeah, that is interesting. So when you think about the pie, the piece, the whole pizza pie, and you're like, well, how much distress is as far as delinquencies, and we're going to talk about foreclosures in a minute. But when you think about that, the stress in the overall mortgage market, um, it's I think there's a misconception out there that a lot of because these they see stats about the FHA mortgage delinquency being 15%, you know, and they're like, wow, 15% of mortgages are delinquent. And it's like, well, no, it's 15% of the it's 15% of the 15%, right?
Yeah, it's an acute problem for the FHA, and for the servicers of those FHA loans. But you're absolutely right. It is not a. It is not a. It's almost entirely right now. It's an FHA story. Perhaps that changes, but not right now.
Okay. And then so it's obviously, like you said, it's stress. It's probably, when I looked at a historical chart, it looks like it's approaching all-time highs, it seems like, as far as FHA goes, when it comes to their delinquencies. How much does homeowner equity and negative equity factor into all this risk right now?
Well, the amount of equity that you have plays a really significant role once you get into. Um, well, it goes towards borrower motivation to continue to stay in the home. If you have 20-30% equity in the home, you are going to be more motivated to to do a loss mitt workout, like a retention workout. Like you're gonna prioritize paying the mortgage because you've got that equity to protect. Whereas if you don't have any equity or you have negative equity, then the calculus might change, and you might be like, well, um, I don't really care. I mean, my credit's gonna tank as a result of this, but I'm not losing that equity if we go to foreclosure, um, or some other loss mitt disposition. So that impacts the borrower's mindset, and then it also impacts what can be done in loss mitigation. Like if you have equity, then you don't even need to do a short sale. You can just do a forced sale if the borrower is ready to leave the house. And the less negative equity that you have, the easier it is to do a short sale, and avoid foreclosure. Whereas if you're deep, negative equity, then as a borrower, you're sort of incented to ride it out, right? And stay in the house as long as you can until they evict you. Um, if if your goal is to stay in the house. So it 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 makes a difference, right? It impacts what's happening at loss mitigation, and then it also it impacts what the borrowers are going to do. And of course, the thing with the FHA loans, particularly for the vintages originated prior to, you know, I don't know, early 2022, there's definitely been home value appreciation for, much of the FHA, much of the homes that are securing the FHA's mortgages. Um, but uh, but when you originate an FHA loan, I mean, you're almost certainly putting 3.5% down. You might be getting down payment assistance. A lot of times you are for that. So, basically every FHA loan that gets originated is immediately functionally underwater because you need to have 5-6% equity in order to cover transaction costs if you go to sell a property, right? um, so yeah, that does kind of put the more recent originations since 2022 at greater risk, because some of those homes have actually seen home value declines since they were originally originated. And yeah, it definitely puts those borrowers in a riskier position if they do hit distress, and make them much more likely to just walk away, as opposed to trying to do some sort of a workout to preserve, a chunk of equity that they don't have.
Yeah, I mean, I have talked to some homeowners recently that I helped, or other realtors. I helped buy their first house, right? And they used FHA. They got the down payment assistance, and at least the folks that I help, I explain to them in very clear terms and show them the schedule of payments and the amortization that takes place, and explain if you're buying this house thinking you're going to leave in the next 2 years, unless you're just going to accept bringing money to closing, you are probably going to be underwater. And so you're right. That is probably a bigger factor for those that are buying recently, because even the areas where home prices are still going up, like here in Ohio, they're not going up as much as they were. They're not, it's not double digit increases. So that plays a factor. The When it comes to that negative equity, I think nationally, the stat I read a couple days ago was 2.1% of all mortgages are underwater. Do you have any idea what it is in the FHA space, like just aggregate in the FHA space?
So it depends on what we mean by underwater. Are we talking literal 100%, or are we talking, the 94-95% level in order to avoid bringing money to a closing table?
I guess we could just use 100%. Well, you tell me, is that what we should use?
Uh, I think I don't know that I have a strong opinion either way.
Okay.
They tell slightly different stories, but the problem with not using the 94-95% is that really kind of defines what the likely short sale line would be. If for sale versus short sale. And that matters because if once you get into a short sale situation, it kind of doesn't matter what how much the house is then going to lose to the borrower, right? Like once they're walking away with nothing from the closing table, um, then I mean, does it matter if? And when I say the bank, it's really the FHA insurance fund that would bear it. But does it matter if the insurance fund takes a $5,000 hit versus a $30,000 hit? I don't know. The borrower probably doesn't care. Um, so the emotion is then gone. And to the FHA, and specifically the servicer, but they're operating based off of figures that are provided to them from the FHA. It's an unemotional decision, right? There's a floor price that they're willing to accept, which is ultimately comes from a figure that's sent to them from the FHA about its valuation. Um, and if an offer comes in above that, then that's going to get taken, right? You're going to get a short sale, that ultimately gets done. You don't have a borrower who's like, oh man, I'm only going to realize 10,000 out of this sale versus 25, I don't think I want to take that offer, right? Like the emotion's gone. I think there's a lot of emotion that's taking place within sellers. And I think you see that with the glacial number of transactions that are out there. You have sellers that are clinging to prices that they want to get, and that's because emotion creeps in. Well, it's emotion mixed with wanting to make money. But once you remove all of that, then that leads to both more transactions and lower prices, lower strike prices.
Yeah, great point on the transaction volume. This, so when I think that's a, well, you've got me really thinking. This 2.1% negative equity number, maybe that's misleading because I'm not sure what they're looking at. I don't know if they're looking at the 100% or they're looking at the 96%. I don't know what they're looking at. It's from, I believe it was from Black Knight, I assume, is where I saw it. But I guess the point is that it looks like, based on the data, that there's a lot more equity out there than maybe we've had in the past. And it seems like that will be that could act as a shock absorber for some of this pain that we're seeing with FHA loans, and certainly the other book of business out there. Is that right?
Yeah, I totally agree with you. The funny thing about equity, though, right, is it relates to, you know, HVI or home value index slash whatever the appraisal is. But that's not how transactions get done. Transactions get done because a borrower makes an offer and the seller either accepts it or they don't, or they negotiate to a strike price. That's where the real price discovery happens. And just because, your Z estimate says that you have $50,000 in equity does not necessarily mean you have 50,000 in equity in your home. That's to be determined when you actually reach a strike price with a buyer of that home. So that said, broadly, the story is true. There definitely is more equity amongst homeowners now than in times in the past. How much of that will start to dissolve once we actually start getting unemotional sales happening from the distress channel, which will be kind of pioneered by these FHA loans, like the modifications of Doom and the other stressed loans in the FHA portfolio, that remains to be seen. One thing that should be noted about that, though, is uh, the negative equity situations uh, for FHA loans. This is going to be a localized. It's going to be a localized effect where you've got because you've got concentrations of underwater FHA loans that exist in various specific parts of the country. So, like in Ohio, which really doesn't have these, the couple of FHA loans, or maybe even it's a little bit more than a couple that end up going to the distressed channel as a result of FHA borrowers who can't afford to make their mortgage payment anymore. Those are going to be fairly distributed out geographically. But when you get into like the outskirts of the Texas metros, it's a different story. And a lot of that has to do with new builds that were completed in the 2022, 2023, 2024 timeframe, where you have a whole chunk of like a builder builds a mass community, right? 1,000 homes. And they sell those homes over the course of like a year and a half period as they build them. A ton of those homes are going to have FHA mortgages on them because when you're selling in the 300,000, 400,000 home segment, FHA is a big, that buyer, the FHA buyer is going to be a big portion of the purchasers of these new builds. So you have a ton of FHA mortgages that get originated all in the same spot. And you've got probably close competition from other building developments that are just a mile down the road putting up another 1,000 homes. Particularly in Dallas, you see this Like it's crazy. If you fly into DFW from the east, just look out the window of your plane and look at all the land as you're starting to come into the city. That's been, you can tell, oh, there's going to be a huge housing development there. There's going to be a huge housing development there. They got the roads laid out. They're all just lot sites. Or just go on to Google Maps and look at the satellite viewer and the Zillow and see it. There's still a ton of supply yet to come there that are going to match underwater FHA loans, some of which are entering distressed. I mean, yeah, the recent originations perform a little better, but there still is distress there, but it's concentrated. It's concentrated in those pockets. And then what's the impact going to be in those localized area? That will be a lot more interesting and probably a lot more dramatic. And you don't really have the equity there in most instances to absorb it because they bought near the top. Many of the FHA borrowers in those areas, and that's one of the regular reports that I do at my Substack. I'll put out maps of where those are, and it lines right up with where builders are. And if you go and you look in those zip codes, like the connection between underwater FHA loans and builders is a pretty significant one.
Yeah, absolutely. I see the same data, John, when I look at just the housing market in general. And I guess I'm seeing it play out on the ground too. To your point, there are massive housing developments in Texas, in Florida, out west, Colorado, Vegas, Phoenix.
Yeah.
And the people in Ohio, in the Midwest, in the Northeast in particular, they have no idea the scale of these developments. In Ohio, you see a housing development, and I mean, there aren't, at least I can't find them, housing developments with thousands of $300,000 homes. There are housing developments with like 50 homes, but they're
Yeah.
700, 800, $900,000, mostly not using FHA loans. And you're right. When I look at your Substack, I can see that data. So, it plays out. We can see that play out on the ground. So, I guess the more of the story is on the FHA loans, as far as where that distress is, and if people are out there going, I wonder if it's in my area, you can find that information with John's Substack, and see, hey, does my zip code have a lot of FHA buyers? Is there distress there? And that's maybe where home prices could suffer more in the near future. And
Yeah.
also, maybe if somebody's looking to buy a home, maybe that's where you can find the best opportunity coming up,
That's true.
right? Because prices can fall because of that distress around them. So let's try to put some context around the numbers we're talking about. So, like, these foreclosures have been suppressed because of these goofy programs from the government, from FHA. They've turned those programs off. Now the foreclosures, the hose is starting to be unkinked. The pressure's coming through the hose. And so foreclosures are rising. It seems like we're getting back to normal levels pre-COVID. Uh, Even though headlines that I see, they'll say foreclosures up 60%. And 60% from a little bit is easy to get. How big is this that we're looking at? How many foreclosures do you think are coming through the pipeline that you can see from this distress in FHA?
I think over the next 12 to 18 months, we're likely to see 250 to 300,000 homes enter the distress channel. And I actually don't think most of those will go the distance with foreclosure. I think, many of those will end up being short sales or deed and lose or whatnot. And not ultimately go all the way to sale, but some will, and maybe more than I think. And there could be a chunk more than that. There could be 150,000 more than that. It's tough to say until we start getting hard data about the number of people who are failing the trial payments, the 3 required trial payments to get a partial claim or to get a loan modification under the new FHA loss mid procedures. Like the FHA was doing around 350,000 partial claims a year over the last year or two. And if those folks fail the partial claim, or fail the mod, then they're going to also go into into the distress channel. So it's tough to know exactly how many of those are gonna go in that route. But we'll start to get data on that starting next month, when the February data is released in early March. We'll start to get an idea. Industry sources have been telling me that they're expecting at servicers, they're expecting 50%. I even heard 60% failure rate from one source within the industry. But the 50% has been pretty widespread of various people in the industry telling me what they expect. And that strikes me as reasonable. But we'll start to get a look at what the hard data says in the next month.
Okay. And then historically, I don't know if you know this off the top of your head, but historically, like it seems like the foreclosure numbers before COVID, like in 2018 or so, we were running like 70,000 foreclosures a quarter. I don't know if that's what I have is in my notes from some research. So I'm trying to gauge, I'm trying to help the viewers understand the scale of these foreclosures coming, and if it's like, oh man, it's way beyond what historical numbers usually are, or if it's like, yeah, it's a bump, but it's not a number that is going to cause a housing crash overall or a lot of pain nationwide. Obviously, localized, there could be pain. Um, so what are your thoughts there?
My thoughts are this is primarily an FHA story right now, and it'll be a very significant amount of pain in the FHA world. So for like servicers that have a high exposure to FHA loans, they're going to feel a lot of pain out of this, but that pain is not at all reflected in the other big portfolios. A little bit in the VA, but not a huge amount, and then almost non-existent right now in Fannie and Freddie. So this is an FHA story right now. That could change. The impacts. We'll have to wait and see what the impacts of will the FHA will that break like a confidence trend within borrowers, et cetera, right? That then has a psychological effect on strike prices. I don't know, maybe, but it will take that in order to turn this into a story that goes significantly beyond the FHA.
Yeah, and it sounds like we may be a little ways off from knowing that, just because the data has to play out and these last ditch effort workouts have to play out, I
Yeah.
suppose.
I mean,
Right?
I would caution that there are other macro forces in play. That the fact that the transactions have been so low for a while, that also suggests that the next leg is down in terms of valuations on homes. Um, so there are other macro forces in play that could contribute to that, but uh, so it isn't just, well, what impact will FHA have, but FHA will have a real impact, and then we'll just see where it goes from there.
Yeah, absolutely. It's I tell people that, we got a decade of appreciation in 3 years.
Yeah,
So it's like, when that happens, expect that things are going to change, right? With prices, they naturally will. And to your point on earlier on the homeowners that are locked in, I mean, it happens every day. When I talk to homeowners, they're like, I just don't need to sell. Like, I just don't need to. Like, if I had an incentive, going back to that incentive thing, if I had an incentive to sell my property, I would. I have no incentive to sell. I've got a low rate.
yeah,
I've got a purchase price. My replacement cost for this home would be astronomical. There's absolutely no way I'm going to move. And some of them tell me they're never going to move. Like, they're going to stay there for the rest of their lives.
yeah,
And I think that the goofiness of these rates swinging up and swinging down, I guess, then up, that's really messed the market up. I mean, it's really locked up the market. And now I'm seeing that inventory is suppressing sales, right? Suppressing pending sales because there's nothing to choose from. The clients I have, they can't find something. I mean, they have the money, they have the credit, they have the job, but they can't find something that makes sense. It's just, yeah, it's not good. So some of these putting these foreclosures through, letting them through would certainly help people, help the market, obviously, right? Um, do you so let's talk about the government structure when it comes to uh, who backs these loans, because this I think is another thing that is confusing with folks is during 2008, during the great financial crisis, the what's the difference between then and what we have now regarding loan structure and who actually backs these loans and guarantees them?
Yeah, ultimately, back in the 2007, 2008 timeframe, um, a lot of the credit risk for mortgages defaulting in mortgage-backed securities, right? There was a lot more of it that was held privately. I mean, Fannie and Freddie technically were private back then. There was the implicit guarantee that the federal government would step in, which they did, and turned it into an explicit guarantee. But outside of VA and FHA back then, there's just a ton of it that where the credit risk was born privately uh, by people who have to fund that MBS, right? And, like in the repo market or somewhere, right? There's just a lot less of that. Like when I say a lot less of it, there's very little of it. Like aside from the jumbos that the banks originate and hold on book, which are done to super well qualified people, right? There's just not a lot of mortgage credit risk that's borne by private entities. It's almost all borne by the federal government right now. That's the biggest distinguishing feature between this, in my mind, between this and the GFC. It's just even if things got like super bad, delinquency wise, like say it shot up, quintupled in the Fannie and Freddie portfolios or something. Um, it's not going to cause the private distress to investors in the way um, it did back then, because the private investors bore the credit risk. I mean, there'll be people who would suffer, the servicers. There are people who are exposed in some way, shape, or another to these loans, if through nothing else, the obligation to service them, which is really expensive when a loan goes into default. But it wouldn't be like the broader investment community.
So it sounds like the government has already, like they're in place to absorb the losses, I guess, versus the private credit industry that we had before. Is that right?
Yeah, I mean, the government prints money, so they're in the position to absorb any loss,
Right. Right.
mechanically speaking.
Yeah, and then in 2008, the other thing through some research, because I wasn't in real estate then, I spent some time going back and researching the loan structures, and one of the things I've heard recently is that the subprime borrower was not the cause of a lot of the loan distress; that it was the prime borrower, the prime book of borrowers. However, when I hear that mentioned, the part that's never mentioned that I think is, a big missing piece there are the products that were given to prime borrowers that caused the distress. So, from what I've seen, and tell me if I'm wrong here, the prime borrower in 2008 during that financial crisis was using like interest only,
Oh yeah,
choose your own payment, right?
yeah.
Can you expand on that a little bit?
Yeah, well, those create payment shock situation for those prime borrowers, and depending on the equity that the prime borrower had in the property, uh, they if they didn't have a lot and their payment went from an interest only payment to a full payment, and home values are going down, they got negative equity. Yeah, they'll take a credit hit, uh, but if they're a prime borrower, they might not need credit all that much. Like if you've got some money in the bank and you've got regular steady job that you're good at, then if you pay your credit card off every month, what do you really need credit for? Makes a few things less convenient, but okay, endure that inconvenience for a couple of years, uh, versus taking I don't know, $80,000 hit to bring money to the table to not go that route. They'll take the 80 grand and keep it and just deal with it. And I think you saw a lot of that happening in the GFC era with those prime. And then, I talk about unemotional selling. There's nobody more unemotional um, than a private fund that's trying to sell the thing that secured the loan that they really wanted to be invested in, and now they don't. Now they aren't. Now they're invested in a depreciating house. They're going to sell that as quickly as they can, at whatever price that they can get to get out of it. And that sets the stage for like really rapid price decline when you've got lots of people selling under those circumstances.
Yeah, absolutely. And it's maybe that's one of the reasons why we're seeing homeowners refusing to sell now, is because if they're like, well, I have most people have a 30-year fixed mortgage now. I think it's like, well, I don't know what the stat is. It's got to be 90% or more that have a 30-year fixed rate. They don't have interest only adjustable loans. So like I think a lot of those products are illegal now. Banks don't even offer them. I think if you try to go to a bank or a lender and say, hey, I want an interest only loan on my 30-year mortgage, I don't even know if that's available. It is for investors on a DSCR, but not a standard, mom and pop. So it's like, I guess I'm trying to frame up for the audience like that. The actual core product used to buy houses now is vastly different than it was leading up to the great financial crisis. That matters, and it matters a lot. And I think that contributes to that lock-in effect. What do you think?
Yeah, I agree. I think even back then, the majority of people were in 30-year fixed, but the loans that were problematic were not. Many of them were not in those. And there's just not many of those products at all that are out there now. So yeah, it absolutely does. It absolutely has um, is a differentiator now versus then.
Yeah. And so looking ahead, if this continues, this delinquency continues in FHA to get worse, then you bring in Fannie and Freddie for some reason, let's say massive job losses across the US, AI bubble. We didn't even talk about student loans. We'll have to do that on another video.
Yeah.
But you get all that wrapped up into it. Um, like, what does this ultimately mean for not only the housing market, but the taxpayers?
Speaking about it just purely from an FHA perspective, um, like the taxpayers will lose money on these loss mitigation efforts, and on the loans that end up going into the distress channel and whatnot. There's definitely going to be a rise in claims. The FHA expects it, and they'll be paying out those claims. But you have to balance that against that. The taxpayers made a lot of money off the FHA program over the last five, really going back 10 years. Um, they, it's a profitable program because they're charging all these borrowers, uh, an upfront mortgage insurance fee. I think it's like 1.75% of the purchase price of the home. And then you're paying an additional, forget what it is today. Is it 80 cents or maybe it's 50, or not 80s, 0.8% over the course of a year, of the loan balance, or maybe it's 0.55. I don't remember. They played with it a little bit recently, but um, borrowers are paying that every month. Not 0.8% of the loan every month. That's on an annualized basis, so 1/12 of that. But you sum all of that cash up, and the taxpayers make money on the FHA program. Then they might not for the next. They probably won't for the next couple of years. But you have that income that offsets these losses. So even as bad as it is right now, it would have to get considerably worse before you would have any sort of a threat to the FHA insurance fund, which has a lot of money in it. It's not quite as big as the you go and look at the headline number. I think it's like 130, 140 billion in funds in the FHA insurance fund. It's honestly less than that because they've got debt that they owe the treasury. It's all kind of government accounting, but regardless, the main principle is the same. It's no real threat to the fund.
Okay. So maybe I didn't ask this right. I'll just be blunt. If things get really bad with all these government backed loans, is it another bailout coming, or will the government step in? Do you think and just say, you know what, these FHA loans are complete. It's we don't want this on our watch. This is falling apart. Now we've got Fannie and Freddie with conventional loans having a problem. We're gonna have to step in and put another moratorium in place.
I mean, it's always possible. It sort of depends on the politics of it. I don't think that, again, so long as it stays FHA, I don't think that the Trump administration is going to do anything this year. Maybe they should from a political calculation perspective, but I don't think that they will. At some point, I mean, the thing is, the government bears the risk. The government already bears they bear the loss. If things got like super, super bad, the government, I mean, is the government going to bail itself out? The government could choose to say, no, we want these people to stay in their houses and we're going to continue, we're going to eat a bigger public loss. So if that's kind of what you mean by bailout, the government could choose to do that. But I think that would be chosen based off of political reasons, because, somebody didn't like the election optics of more than, I don't know, a couple 100,000, bit more than that, who are kind of facing losing their homes, which is what the story in FHA will be this year. If that becomes millions and millions and millions, then yeah, maybe they come back with loss mitt programs similar to what they were back in 2021, when there was a very real concern that people would face that situation in 2020 into 2021, which was where the kind of impetus of these programs came from.
Yeah, I agree. It's a who knows what'll happen, but the mechanism is there, I guess. Right? It's like, well, we're already backing up these loans, so we don't have to do much to put one of these programs in place again. And you, like you said, is probably based on political optics. Well, this was educational, John. I appreciate it. I mean, every time I talk to you, I have 1,000 more things that I want to ask, but I know you have to go. So, look, folks, if you want to know what's happening in the mortgage market behind the scenes, you've got the expert right here, not me. John Comiskey is the expert, and I would, if I'm you and you want to know about the mortgage market, go to his Substack, subscribe, support him. Independent journalist, right? That to me, that's what Substack's about. So I would check him out, subscribe, and we'll do another video as the spring selling season takes hold, and maybe more of these foreclosures, flow through the system. So, John, I appreciate your time. I appreciate your knowledge. And I thank you for coming on the Housing Nerd.
Absolutely, Jason. Super appreciate you having me.
Yep. We'll talk to you.